plates if you're done. They'll keep filling your coffee or your soda if you ask them. And I'm going to get started so that we can be done on time tonight. We're going to try to be done at certainly before 8. So it's kind of like trying to get the attention of my family at my dinner table. This is going about the same as well as that happens there. Appreciate you being here. And again, if you have to get up to use the restroom, it's outside the doors. If you have to get up and get a second piece of dessert, I totally understand. Please go do that. And if you walk around a little bit, the microphone mic's up all the way out to the back, so we can hear each other while you're doing all that. So. All right, so this one is called Returns, Returns, Returns. And just in case you're sitting here wondering why on a very nice spring evening you're sitting watching a guy in a suit do a PowerPoint presentation, let me give you a little bit of a perspective on why returns are so important. Many of your life's goals and dreams, certainly a good amount of your ability to help others, and maximizing your retirement income are all tied to investment returns. I was thinking about a good way to give even more perspective to this, and I thought, this is probably right. Investment returns are to your retirement or your later years, however you see retirement or whatever you think about, as your paycheck is to your working years. Put more simply, investment returns are your retirement's paycheck. So, investment returns are your retirement's paycheck. And when I show you that Dalbar information where we say that the market gets 10% and the average investor gets 3.9%, most investors are content with their money showing up for work 100% of the time and getting paid a third of the time. How many of you would show up for work 100% of the time and every third week get a paycheck? How would that be? But as investors, our money is at work. We call it sometimes capital at work. And your money's getting paid a third of the time or getting paid a third of the amount. And that's if you're average. Some people to make up average have to be worse than that, and some people are better. So to give some perspective to this, returns are very important. Returns are your retirement's paycheck. And when returns are meaningless, when we're not tracking them, when we don't care about them, when we think they don't matter, we do all sorts of things. We've talked about them if you were here for the previous presentation. I won't go into them in detail. We market time. We get in and out. We feel like being in the market right now. We feel like things are going to go well. We stay in. We feel like getting out of the market. We feel like things aren't going well. We'll get out. So we market time. We stock pick. We buy and sell. We look for a home run. Couple of examples were given here. You put $1,000 in GM. It's got to go up. It's 15 cents. GM's not going away. It goes away. When returns are meaningless, we're willing to do some of these things. We'll track record invest. The best performing mutual fund last year was QSTFX. You can go look it up. It got a 70% return last year. Now, to give you perspective again, the U.S. large company market, the S&P 500, got about a 21% return last year. Emerging markets, which you own, was the best performing asset class. It did about 36% last year. And QSTFX went 70. QSTFX uses an STF model where it'll own tech stocks and long bonds. And based on a formula that they came up with, they buy and sell. Looks frantically, but they came up with a formula which in 2017 really struck. They've been around since 2015. So in order to get that rate of return, you would have had to have been in it within a year of it being, invented, that mutual fund being opened. And on the year this year, it's had lackluster results so far in the first four months of the year. But it had a 70% return, and Morningstar is all about it. The other issue about a 70% return, if you're a mutual fund that got a 70% return one year when the market did 21, that 70% is going to average into their next 1, 2, 3, and 4, and 5 years pretty favorably. They could underperform the market for the next 4 years and still get a Morningstar 5-star fund review 5 years from now, 4 years from now. Does that make sense? You could buy it now based on this 1-year track record, never even achieve market returns, and then watch them get a 5-star rating from Morningstar in 4 years. That's how this works when returns are meaningless, when we're not tracking. We'll do other short. The green light's back, and we're back. Perfect, Gary, thank you. Perfect. So we'll do short-term performance like gold, commodities, futures, Bitcoin. We'll get into stuff because we're just looking to capture something. We're looking for something. We're wanting a better return, and we don't have any way to track it, so we do this kind of stuff. And these techniques and strategies, there is no known correlation between those and success in investing. The academics have looked at market timing, they've looked at stock picking, they've looked at all of the people who do it, and there is no correlation between those who have had success with them in the past as being a reliable method for those things being successful again in the future. And it leads to investor upset. It's a poor performance, and we get frustrated as investors. And so, and rightly so, but returns are not always meaningless. Returns have meaning. They're very important. And you wrote down earlier some of the things that make them very important, and you all have families, you all have goals, and you all have things you'd like to accomplish that rely on returns. And many advisors who are offering access to these low-cost funds, they'll talk about the right things. So you have a low-cost index fund, and you think, hey, that's on the right track, and it might be. They'll talk about the right things. They'll talk about efficient markets. They'll talk about modern portfolio theory. They'll talk about the 3-factor model. These are the 3 essential or the investment bodies of knowledge or theories that we work with to build our portfolios. But is it true? They talk about them, but are they building their portfolios on them, or are they just using these to sell their portfolios? They're using the words efficient market to sell. And I was trying to think about a good example to illustrate how this works. So I wanted to talk about my run this morning. I went for a run this morning. Right, babe? I did. I went for a run. I am a runner. Now, come on. Unless your wife is in the room, as a mutual fund manager, you could get away with that, right? Here's my run. I use a little app called the Runners app. Right? And this is my run. This is the little cemetery around our house that we walk in often. And this morning I ran in. I did run. And I ran from the green dot. I retraced my steps and I went. So I have some data. And this was this morning, April 24, 2018, 6:42 a.m. I got up at 5:30, which I often do on a presentation night. I went through my presentation in the morning. I went down. I woke up my lovely wife. We went for a walk together. I did a little running. And these are my stats. I've got stats to prove it. I'm a runner. Let me give you a little more information. Let me slide this up a little bit. I ran 0.79 miles this morning. Nobody laugh. It took me 7 minutes and 13 seconds. I'm on track for a 9-minute, 10-second mile. I burned 120 calories. Now that's good. And other than Sunday, that was the first time I ran since last Memorial Day weekend. Sunday, I think I ran 0.68 miles, and it took me about the same amount of time. So I am improving, and I've got a lot of emails from the running app to say that I'm doing great. I set a new personal record for distance this morning. So this is my running app, and it makes me a runner, right? And I've got stats to prove it. But how I talk about that and what's really happening are 2 very different things, right? And mutual funds can take all kinds of stats and make things look very differently than maybe they really are. Saying and actually doing are two very different things, especially in mutual funds and in the advising world. So flexibility does not equal discipline. Now, I want to make sure that I talk about this correctly, because flexible plan investments are all the rage. You could write that down, flexible plan investments. And kind of like when you buy a red car, all you see is red cars. If you write that down, you'll start to see it. You all get emails, right, from people trying to sell you financial products. Who gets emails? You went to a site, you put your information in there in a moment of weakness, and now everybody's sending you emails. And flexible plan investments are a big deal. I don't want to communicate this wrongly. Being flexible as an investment advisor with my calendar is really good, right? Helping you get in for we can meet together. For me to be flexible or help build a flexible financial plan, that can be a good thing. But for me to be flexible when you come in and you're afraid of what the market's about to do, or for me to be flexible to add commodities to your portfolio because your Uncle Steve said gold was going to go up and you want that as part of your portfolio, that kind of flexibility is not what you're looking for from me. And so there are a couple of questions. Let's say you're in your 401k advisor's office or you're in a financial planner's office and you want to know, is this something I can trust? Well, here's a good question you could ask. You could ask, how well have you captured historical premiums or returns and remained disciplined with all of your clients? That's a good question. It's not how have some of your clients done. It's not how has the market done or the mutual funds that you use done in the past. It's how have all of your clients done over the entire period that you've been working with clients. How has all of your advice turned out from the beginning? That's a better question. Another way to ask it is, got GIPS? Now GIPS is Global Investment Performance Standards. Global Investment Performance Standards. And GIPS is a governance structure and a methodology of tracking and tracing investment returns. Now, you remember I've used a couple of words throughout. Morningstar, I used Morningstar as a example. Morningstar is a good company. They rate mutual funds. Okay? They don't know when you bought and sold the mutual fund. They don't really care, but they just rate the mutual fund and they tell you how well this mutual fund did as compared to the market. It's valuable information. I'm glad they do it. So Morningstar does that. If you looked at all of the Matson Money family of funds, you could find them all on Morningstar. You could look at all of their stats and find out a lot of good information about them. Then you've heard me talk about DALBAR. DALBAR is that organization that rates investor returns, and we'll say the market did 10 and investors did 3.98. Right? We'll look at that again here in a few minutes. DALBAR tracks investor returns. Irrespective of the mutual funds they use, all stock purchases and sales are tracked in this country. It's a public trade, so we always know what happens, and so we know how well you're doing on an average. We don't know how well you're doing versus you, but we know how well investors are doing and what kind of return they're getting, and DALBAR gives that to us. But until GIPS, nobody has tracked the particular return of the advisor with the client together. How well have they done together? How well has the client done for a particular advisory firm or a particular fund family that does things in a particular way? And GIPS gives us that. It's growing like mad. 39 countries have now adopted GIPS as the standard measurement to measure advisors' performance with clients. 39 countries now have adopted that. It gives us fair representation and full disclosure. It's everybody. I've had, Liz could probably tell you, 4 or 5, I think we're up to 5 clients over the last 13 years that we've been doing this that have left our firm to do things a different way. It's not bad for 345 total client households, but 5 have left. My GIPS rated returns include those 5, not just the ones that are left. Okay, some firms have not had the blessing of clients who have been as loyal. And so when those clients leave, oftentimes you can say, okay, I no longer have to produce that data, but GIPS requires us to produce it. On everyone who was disciplined, everyone who wasn't disciplined, everyone's performance is in there. It's fair representation and it's full disclosure. It instills confidence. It instills confidence in me when I work with Matson Money, and it instills confidence in you when you work with someone who can give you that kind of assurance that we know exactly what all of our clients are achieving market-wise and return-wise in any given year. And it drives integrity. Now, here I talk about integrity, and we have lots of definitions maybe for what integrity could be, and not that that's bad, but I have a good article here. I had a good article here, which I can no longer find. Here it is. If anyone wants it, on your comment card, you can just write down the word integrity, and we'll email a copy of this little interview. Michael Jensen of Harvard writes this paper, and he says integrity, for the purpose of financial institutions, we're not going to talk about this as right or wrong at this level. We're going to talk about it as whole or sound. Do they do what they say they're going to do, right? And are they giving the information that best describes the situation? Unlike my running example, right? I'm a runner. I ran this morning. Here's my route. Here's the date, right? There's more relevant information than that to get you to think whether or not I'm an actual runner. And same thing with mutual funds. And it drives integrity when every client's performance has to be put into a composite and sent up to be verified by GIPS. And it's firm-wide. It's all decisions, it's all trades, all clients that have ever been there, and all trades and investments that have ever been. Another trick in the mutual fund industry is when a mutual fund is discontinued, the mutual fund by law no longer has to promote that particular mutual fund's performance. Most mutual funds will get discontinued for one reason. They underperformed or they were no good. Nobody wanted it. Once they kill that fund's information comes out of everything that mutual fund advisory firm has to promote or give to you in their prospectus. And so this is a concept called survivorship bias. Their current returns that they're telling you they get are biased toward the surviving funds. Does that make sense? Well, GIPS doesn't let you get away with that. It's firm-wide. It's everything that has ever been. Composite performance. Every client, you might have one mutual fund that's very aggressive. You might have one mutual fund that's very safe. We do that for a lot of folks who are in retirement. We want a mutual fund where they can get their income out in retirement, but we want an aggressive pool or a more aggressive pool because we want to have a pool of assets that can be used to stave off inflationary concerns over the longer term. Well, each of those pools need to go into a separate composite and go in and be verified under a GIPS model, and it is. There's no simulated or back-tested returns that are promoted. So we could tell you, here's what you would have gotten had you invested this way. But we didn't really have any clients in it, but here's what you would have gotten if you had invested this way. And it's back-tested, and it works. Had you invested this way from 2000 to 2020, this is the kind of return you'd have gotten. It's simulated. Again, no actual clients were in it. This is probably the most common practice in investment firms, that they'll provide a simulated performance, and I'll show you a couple of examples. So GIPS requires that all of a firm's discretionary fee-paying portfolios be included in at least one composite and sent up for verification, and it's all part of the mix. And it comes at a cost, especially initially. Mark Mattson decided to do this, and he didn't necessarily know exactly how it was going to turn out. He knew how many clients had done, but if a client leaves, did they leave at the wrong time? If they panicked and sold, as an advisor, I'm not going to move them into something fixed. I'm going to coach them to stay disciplined, and if they want to move, they're going to move. And that sale at a down market affects all of our returns negatively. So Mark didn't exactly know how this was going to turn out. Turned out pretty well, and it came at a big expense on the front end. And then all returns are dollar and time weighted and submitted. And then you have this calculation. This is how you do it. There are 40,000, I think, households with 4 or 5 times that many accounts. Each one of them gets run through this equation every month. Each one of them is submitted then in a composite, each account, every month, every year, for as long as we both shall live, as Tom Hanks says in You've Got Mail. So this keeps going and going until death do we part, and by death and both, I mean Mattson money and your money are no longer together. As long as they are here, we will be putting this composite or this formula together for every one of your accounts and submitting it. And we want to arrive at this magical little piece of data, which is a compound rate of return. The compound rate of return is what gives you the ability to plan versus guess. Gives you the ability to make decisions based on facts versus wonder how things are going to turn out in the long run. A compound rate of return that you know has been achieved on average by every investor that mutual fund manager has ever worked with is what we're looking for. It's not a best representation of one successful client. It's not, these 9 cherry-picked time periods. It's every time period, every client for Matson Money since 1992 when they started their mutual fund mix. And it achieves this compound rate of return. So when we're sitting in my office and I'm using an Excel spreadsheet and we're building the 2-pool model, you see the returns off to the left. How many of you have been through that experience in my office? You've seen the 2-pool model. We've looked at the returns to the left. These are the actual returns that have been achieved on average, net of all fees, by all clients. Now, the good news for you is that you might do better than that. Because again, this is the average of all. And you might be a more disciplined investor than our average. Obviously, the ones that bailed in the middle of 2008, and we didn't keep every client disciplined. We tried. Did more seminars in 2008 than maybe even this year. And this year we've stepped it up. So we tried, but we didn't keep them all. And so those have come out, and those returns are in those averages. So you could even be doing better than our compound return by a small amount, maybe 0.5%, but that makes a big difference. But it's this compound return that gives us the ability to know that we're getting a paycheck every week, right, in our retirement. That our retirement money isn't at work 100% of the time and getting a paycheck a third of the time or less, but that it's getting the compound rate of return of the market. And again, Mark Matson submitted all this information a number of years ago, and they accepted his firm quickly, Matson Money, quickly into the GIPS Investment Performance Standard family. And there are benefits to this. It represents industry best practices, and compliance demonstrates a firm's commitment to ethical practices. Ethical practices. That's easy to say, right? Should be easy to do. It's say what you do and do what you say, but you would be surprised what we find out here in this industry. Before standards were produced, managers could present their performance in a variety of ways to present this in the best possible light. Just a few examples. They use representative accounts. So this is 10 accounts that we've chosen to give you a sense for how some people did in the past 10 years or 5 years. Selective time periods. They'll cherry pick a time period where they happen to perform pretty well, or they'll cherry pick a time period where the market did really well, and they'll produce those returns for an investor, and they'll show them, see, you could potentially see results like this. Lots of disclaimers. Different calculation methodologies. These are just a few, but the list can go on. But with GIPS, the verification is done 2 or 3 different ways, and it's done by an independent firm. It gives greater credibility to a verified firm than a non-verified one. Because you can know, again, that every client, every period, every trade is in there. ACA Compliance Group is the name of the group that that monitors and evaluates Mark Matson's company or Matson Money and their family of funds. If you wanted to do this, I had one client in the past 5 years that I can think of, and it was just 2 weeks ago. He said, "Can you give me the compliance group that verifies your returns?" And I said, "Yes, I can." And he almost fell off his chair because he's in HR at this company, and they've been interviewing 401k providers, and no one knew what he was talking about. No one could do it. And I said, "Yes, I can. It's the ACA Compliance Group. You can give them a call and ask them about Matson Money." And they may even have me listed. I don't know if they have their individual advisors underneath listed, but if they do, I said, let me know, and let me know what you find. He said, "So you have verified returns?" I said, "Yeah, GIPS rated returns." And he didn't know what GIPS was, but he was looking for verified returns of all the clients. And we could do it. But I've had one client, I think earlier than 5 years, another one, but 1 or 2 clients total ever ask me for verification. Now, if you wanted to do an independent verification of Matson Money and Mark Matson, you could do it by getting online and Googling ACA Compliance Group and calling their 800 number. Or if you wanted to do even one step back, you could call GIPS and ask if ACA Compliance Group is an authorized accounting firm. And then you ask ACA, is Matson Money on your list? And are their returns verified? You could do that independently. I don't give you the phone number, you go find it. And this is something you might want to do for your family. Just make the phone call. Just be sure. It's not a bad idea to do. Due diligence from ACA meets GIPS and the AICPA standards. And it's not unreasonable to ask a firm to do this. Again, it's not easy to do. It's not something that firms can do with no expense. Initially, there will be great expense in both human resources and probably some technology and software to get at all of these. But as Mark Madsen has come to famously say, firms gotta want to do it. And if they want to do it, they'll do it. Because it's not that hard. It's not impossible to do it. And so it led me to ask this question: why would a firm not be GIPS compliant? What would keep them from doing it? They should be proud to show their results, right? They certainly are proud on the sales end when you're in the office and they're saying, hey, use us, right? They're pretty proud of their results then. Let's show the results on the back end. Why would a firm not show the results? Possible reasons that firms don't provide GIPS. First one, there's no money. Sorry, had to start with a joke. The money's gone. Okay, that'd be one reason why you wouldn't want the ACA Standards Group or GIPS in your business. Not sure why the SEC didn't ask them to show them the money, but that would have been a good first question. They never did. They never asked for the custodial accounts. They never knew or asked why Bernie Madoff owned all three companies. This went on for way too long, but it could have been known by every investor if they just would have asked who's verifying this. No discipline. There's a different process for every client. If you come in and you're into Bitcoin right now, your advisor probably has a product. If you come in and you're talking about, you think, after the election, Europe is going down, they'll move you more into the US if that's how you feel about it, or if that's how they sense you're feeling. There's not a necessary conviction level on their side or on their end, and there's no discipline. There's no real strategy. The strategy I came from was a 5-star strategy. It was a strategy, but the mutual funds that I was given on any given year were the 5 and 10 year winners from the past 5 and 10 years. And so if Jenny and I didn't have a baby that year and we had time to meet with our advisor, and those years were slim, then we would go in. And we would go in and meet with our advisor. And if I didn't go in this year, I'd go in next year. And the strategy would change depending on the time I could put in my calendar to go visit with my advisor. And that has always kind of troubled me. But these were the all-stars, right? So you have the fund families like Fidelity and T. Rowe and Merrill and Vanguard and TIA. And then you have their winning mutual funds in each one of the fund families. And so you look at the NBA teams, you've got the Bulls and the Pistons and the Cleveland Cavaliers, and I'm already dating myself just a little bit because I said the Bulls and the Pistons. And that's the last time I watched the NBA in any real meaningful time. But then on each one of those, you have winning players. Well, you have Fidelity, and then you have their winning player. And he would build portfolios for me based on the winning player of each mutual fund family. That was the strategy. And I ended up with a bunch of tech stocks in 2000 and lost 70% of my money because we just kept buying what was doing really well, and I ended up with very little diversification. There's not a real manager. They're not managers, they're facilitators, they're salespeople. Clients come in all the time, to my office too, especially in 2014 and 2015. The market returns were not great in 2014 and 15. I, like you, am thankful for 2016 and 2017. I like it when returns are up. I love it when they're way up. If I ever get excited with you about a negative 4% return because we matched market, I apologize in advance. I'm still excited we match market because matching market is the point, and sometimes the market's down. But don't let me communicate that I'm excited about down returns. I don't like them. And clients walk into my office and they look a little crossways at me, and I don't know where you're coming from sometimes. I don't know if this is it, or if we're going to have a knockdown drag out, or how this is going to go. And I've had a few of those. No one in the room, I think. But we have hard discussions sometimes, and we talk about what the right thing is to do in down markets. And so managers and advisors do that. Facilitators and salespeople will respond to your feeling and sell you something that will cause you to walk out of the office maybe with a smile on your face. Getting close to lastly, maybe their returns stink. Maybe they don't want to know. They don't submit to GIPS. They're just not interested in knowing how all of their clients are doing. Here are some examples of non-GIPS performance, the games that people play in this industry. This is an indexed annuity. Some of you have maybe owned indexed annuities in the past. This is one. And the blue line on top is the performance that the indexed annuity is saying it has, the dark blue line. The light blue line would have been their fixed annuity. So if you'd have owned their fixed annuity, you would have gotten the light blue line. And the purple line is a period of time in the S&P 500. So if you would have owned the stock market, S&P 500, you would have underperformed during this period their fixed annuity, and you have vastly underperformed their equity indexed annuity in the dark blue. But this graph is based, this is an ad, okay, not from a company. We just blocked it out, so we're not trashing companies here. This graph is based on an actual crediting rate for the period shown on the X product, which is no longer available for sale. So that's helpful. I'd like that product. But the other thing is, it's an illustration. It's a depictor of an actual policyholder's annuity. The way equity indexed annuities work is that your return is based on the day you buy it, because it's always point to point. So if you come in on January 7, the next year in January 7 is the next time they're going to run a calculation. If you happen to have to cancel that appointment and then come in February, your whole indexed annuity performance and experience is going to be different. It's going to be based on a different set of dates. That's how indexed annuities work. So it's actually very unlikely that they would have two clients in anything similar or in anything the same. But this is a depiction of an actual policyholder's annuity. Do you think it's one of their best policyholders? Or do you think it's one of their worst policyholders? It's probably one of their best, and probably has something to do with why you can't get this product anymore, would be my guess. This is a mix of assets that is using dimensional fund advisors. You hear me talk about dimensional fund advisors. We use dimensional fund advisors, family of funds inside our funds, and so do many others. And this is a portfolio set of returns and descriptions. And on the bottom it says, portfolio performance does not reflect the deduction of any fees charged by an independent investment advisor or other service provider to an individual account. Such fees, if taken, will reduce the performance quoted above. The model performance information reflects various allocation changes made over time, and therefore the underlying mutual funds used in calculating the portfolio performance may not represent the trailing returns of portfolios or the mutual funds. So in other words, what is here isn't necessarily what you're going to own or anyone else has owned. And by the way, fees weren't removed, and so the returns would actually be quite a bit less. That is awful. This is a simulated portfolio performance for year ending 2008. And then another one with the advisory fee in. So now we found one here that this is an advertisement where you can get it pre-fee, gross returns, and then post-fee with advisory taken out. Both simulated. Our investment strategy is based on the principles of modern portfolio theory. So far, so good. Sounds great. The modern portfolio theory, that's what we talk about. That's a theory that we want to utilize. Commodities may be added to some client portfolios for the purpose of additional risk reduction. Well, we've left modern portfolio theory already 3 lines down. But worse, this information should not be considered a demonstration of actual performance results or actual trading using client assets and should not be interpreted as such. The results are based on the retroactive application of a back-tested model that was designed with the benefit of hindsight and should not be interpreted as the performance of actual accounts. By the way, here are our post-advisory fee returns on accounts that we made up after the fact. Now, if they're going to make up accounts, why would they go down 32%? If you could just know that you needed to own Small International the whole time, if you were just going to use hindsight bias, it's crazy. I mean, this is not even past performance, then is not a guarantee of future results. Simulated strategy started in 1996 and have evolved over the years. That is terrible. But this one takes the cake because this one is just actual misleading. Kenny Gatliff is one of the senior portfolio managers at Matson Money. And in 2009, as they often do, especially after down markets, they will call competitors and ask what their portfolios are, what they own. It's just a practice. They probably do it to Matson. Matson does it to others. Mutual fund managers are always curious, what do you own? And in 2009, when they called, this is what they said their mix was in 2008. So at the very end of 2008, this is what they said their mix was of assets. So Kenny remembered that he had done that 3 years later, and now it's 2012, and he said, I wonder what they'll tell me. So he said, tell me what your mix was in 2008. So in 2012, he asked them what their mix was in 2008. Here you see US stocks and international stocks, period. That's what they told him in 2008 was in their portfolio in 2008. 3 years later, in 2012, now all of a sudden they own real estate and commodities in their 2008 portfolio. That 3 years ago they told them they didn't own that. Now, 3 years later, after 2008, if I could have known the commodities were going to go up, I would have put them in the portfolio if I knew it. I wouldn't be working here if I know that kind of information, but I'd have done it. Right? We build a portfolio with future sight, we would do it. But they didn't know that. They used hindsight, again, to rebuild a portfolio and then present it to someone who's calling and saying, what did you own when the market crashed, its biggest crash in 80 years? Oh, we own commodities and real estate. Well, that sounds really smart. Yeah, we're smart. And then you can look at the disclaimers. So it's non-compliance. GIPS will never let you get away with that. GIPS wants to know what your actual clients actually owned and actually bought and actually sold and actually did. All of this simulated, back-tested hindsight garbage is thrown out because GIPS isn't interested. All GIPS wants is what the clients do. No cherry picking of accounts, no cherry picking time periods or strategies. When that doesn't work, just throw simulated portfolios that have no basis in reality whatsoever. Even if they should know better, they've been in business 20 years, they've got lots of data, let's just get it analyzed. So these are the numbers again, right? The average investor is getting 4, the market's getting 10. In bonds, similar story, but even worse. The average investor is getting 0.5% in bonds. And over the last 30 years, the bond market has been averaging more like 6. So inflation at 2.65. Many clients are not keeping up with inflation with their money. They're just happy to get back what they put in. So returns matter. They reinforce the message that we're doing what we say we're going to do, and that your money is where it's supposed to be and doing what it's supposed to do. The Matson principle is you should never invest one dime with anyone who cannot provide verified performance. And GIPS is the only organization that does that. And that would be what you should be looking for. This is a funny little thing that Zach Shepard at Matson Money put together. Here lies mountain charts. In the 1980s, you may remember this, all you saw was mountain charts. Mountain charts are those charts that show the stock market for various people just going up and up and up, right? It's just always up. From 1975 until the early 2000s, 25 years of markets being up. And everybody was showing you their mountain chart. Markets are up, you're going to make a lot of money. But we haven't seen mountain charts very often. People aren't looking at mountain charts, and I'll show you why in a minute. People don't want to see that big, scary 2008 dip. It doesn't sell, right? But it's there. And if you're going to put your money in an aggressive account, and I don't tell you that 2008 was there, that's bordering on malpractice. Certainly isn't 100% honest, but there it is. This is a mountain chart. I start with this period because it's a very relevant period starting in 2000 that has maybe 2 of the biggest declines that we've seen, which really, if you overlay 1929 through 1939 over this, the first crash in 29 was bigger and the second one was less. Here, the crash in 2008 was bigger and the earlier one was less. But what we went through in 2008 as investors, you can pat yourself on the back, was within 5 or 6% of being the same amount of loss that a diversified portfolio would have gone through in the 20s. So this is our big one. And we started our firm in January 1 of 2008. That was also fun timing. Our accounts, our clients were looking for better answers, and so it actually turned out to be a good time to start a firm because we were doing presentations like this, and making some sense. But the S&P 500 during this period of time was getting around a $211,000 return over 17 years on a $100,000 investment. The aggressive growth net of fees would have taken you to 284. The international scene and the small value companies, as we talked about earlier, did very well, bringing them over. A few more mountain charts here. Look at the green line. This is our aggressive growth net of fees. $100,000 in our aggressive growth net of fees almost multiplied that money by 6, $575,000. The long-term growth, this is your 75% stocks, net of fees, $475,000 was the actual average client's return. Now again, the mutual fund did better, but the average client performed right at that level, and that includes all the clients that bailed at the wrong time and maybe did the wrong thing. That's what these are charts to show you. This is how well our average client did. I'm telling all my clients, if you'll let me coach you, you can do better than that, and that's true. This is a 50% stock, 50% bond portfolio. $375,000 would be the growth of 100 over 25 years. And then even the income and growth, where this little dip was back again within a few months. This is the whole 2008 move. Many of you who have your safe pool and your aggressive pool had your safe pool in this account here, which still is getting a pretty nice rate of return. And if we get inflation, which many people are concerned about, that'll just increase further because the bond part of the portfolio will do pretty well. You might have seen that the 10-year note, bond note, just hit 3% for the first time. That was in the news today. So interest rates are rising on inflation or fears of inflation. That is actually going to help your portfolios perform a little bit better, probably on both sides. And so your dreams or goals are tied to returns. It makes returns pretty important. And I want you to get paid every week when you go to work. And I want your money to get paid every day that it's at work. And we want to verify that for you. And so that's our presentation there. I want to give you 3 more slides on the retirement readiness piece. And we have folks here that are of various ages. And so I have a couple of different groups that I want to speak to real quickly. And if you want to, you could just write retirement readiness on the card if you want these 3 slides. You don't have to take all this information down. Just write retirement readiness, and I'll send you all 3 of these slides. These are simple slides that are the principles that I generally use when we build a retirement readiness plan. How many of you have been in my office and looked at an Excel spreadsheet with respect to your retirement readiness? And it's a helpful little thing to do. It's very simple. It's all in one page, and it gives you a sense for where things would look at market returns in a relatively low inflationary period, because that's what we've had. And these are the principles. So if you're under 50, these are the principles that I'm generally utilizing. Number 1, ignore Social Security. Now, most articles that I've read about Social Security, if it's going to change, it's going to change somewhat for people under 50. If you're in your 40s, I'll take what Social Security says you're going to get, and I'll generally divide it by 2, and I'll plan with that number. If you're in your 20s and 30s, I just say flat out ignore inflation. It could be here. It might be called something different. It'd be hard to believe the politicians could think they're going to get reelected if they take your money for 20 years and give you nothing, but I don't think we can plan for inflation. So if you're under 50, we do that. Second, don't borrow money for anything that doesn't go up in value. I have in mind here, a home is a pretty good reason to borrow money if you do it wisely and responsibly. But for just about anything else, don't do it. I'm not really nailed down like Dave Ramsey is on some of these things. If someone had a need for a good van and they put a little money down and they borrowed a little money and paid it off really fast, I'm okay with those kinds of things. I'm not a Dave Ramsey yes or no soup for you type situation there. Education funds, I may have to borrow a little money for my kids' education to get all the way to the end. Probably will have to borrow a little money, but we'll do what it takes to get all the way there. We're going to do it responsibly. We're going to make sure we're getting the education that we can afford, and the kid's going to have some skin in the game. You can bet that. I'm the youngest of 8. I did. And so for the most part, don't borrow money for things that don't go up in value. Pay off the debt you have as fast as you can. If you're looking for a plan or way to help do that, you can talk to me or the folks in my office. We can give you a debt snowball plan. Then save 10 to 15% of your income for the long term. Save it the way we've been talking about. Put it away if you're Younger than 50, you can be pretty aggressive still if you've got a ways to go. And then lastly, pay off your home, if you can, before your kids reach age 18. It's a really good college funding mechanism. To have no mortgage payment by the time your kids turn age 18 is a great way to fund college as you go, or to really help them with that if you can do it. Now, if you've got kids at 12, 13, 14, you can't get there, let's at least put a plan together to get the mortgage paid off by the time you retire, because if you don't have that mortgage payment, that reduces your need for retirement income, which in turn allows me to keep your portfolios a little more aggressively managed in your retirement, because we don't have to drag a mortgage payment out of it every month, right? So we can keep a little more in equities, we can get a better return in your retirement, and it beats the alternative. I used to run the numbers, some of you might have been here 15, 20 years ago, I used to run the numbers on borrow the money on the mortgage and invest the difference, until I really got to know what investors will do. When they have a mortgage, they're less likely to be a disciplined investor. When they have debt, they're less likely to be a disciplined investor. And so we do try to get a mortgage paid off or some debt paid off prior to retirement if we can. Now, retirement readiness if you're over 50. One, there are 4 big things you can do that will increase your retirement income at this stage, and this in this order as well. Unfortunately, the first one is work longer. That's probably the number one thing you can do to increase your retirement income. It increases everything. It decreases one thing, and that is the number of years you'll be retired, right? But other than decreasing that one thing, it'll increase your Social Security payment. It'll increase maybe your pension if you get one of those. It'll increase the amount of money you have to put in the account. It'll increase the amount of debt that you can pay off. So working a little longer is generally the number one thing you can do. Secondly, it's eliminate debt. If someone comes to me with debt and we have a fighting chance of eliminating it by retirement, more than saving more, I'll say let's get rid of the debt, because what you do have saved is going to be more valuable to you without debt payments to make. Then saving more, and then using a higher allocation to equities. Now, I say it this way. I don't want to say, hey, remain aggressive in retirement. No, just a higher allocation in equities. If you were thinking you could handle a balanced 50-50 fund in retirement, if we utilize a 2-pool system, I think you could probably handle 60% in equities, maybe 40% only in bonds. And if you have more stocks, you'll have a better return over time if you have a good plan and a coach to keep you disciplined when the market might turn downward, and you have a good safe account to rely on for your income. So the 2-pool system is really good. And then 3 things that, I think it was 3 things I came up with, that everybody can benefit from for retirement readiness. Have a simple financial plan. It should fit on one piece of paper. And I do business with people who have high net worths. They own lots of companies. They have lots of money flowing and changing hands. But even the more complicated it gets, I learned this from the high net worth clients, if it doesn't fit on one sheet of paper, if it's more complex than that, it's probably not a good plan. It's probably not something that fits in your head, frankly. So we want to keep it simple. 2, we want to use an optimized, engineered portfolio with verified annual compound returns so that we can know we're planning and we're not guessing. And then a willingness to be coached throughout the process. And if you have those 3 things all, then you do well over time. That's what I had for tonight. I'm so excited for 100 people here. This is great to be able to do this in one big spot for all of you. For me to be able to go home and prepare talks like this and then give them in this kind of a venue, it's a big blessing to me and my family. I want to meet with you all, but if we were doing each one of, I couldn't get these concepts out all one by one, right? In one-on-one meetings, all of these, they'd be 2 3-hour meetings. Your eyes would glaze over. There'd be no good food. So this is a really efficient way for us to do that. And so I really appreciate you all coming out. Thanks for coming. And I'll stick around to answer questions for anyone who has them. And again, I should say one more thing. This card here is for you to fill out. If you're new and you want to meet, this is my big pressure sales point. Check the yes box. That will mean we call you. And if you don't, we won't. And if you're a client already and you want to meet or you want a phone call, just write your questions down if you have them, or just check the yes box and we'll call and reach out to you guys right away and schedule something. But do, if you don't mind, just fill the card out and hand it in. And then if you want a copy of that integrity paper that I talked about, write integrity down. And if you want these retirement readiness sheets, we'll email them to you if you write that down as well. Thanks again for coming out tonight. Have a great evening.